Hello, and welcome, and thanks for being here. I'm glad you chose this session. Today, we're going to be talking about how banks, payment companies, and other companies take stablecoin projects from ideas to implementation. So a bit about me as an introduction. I'm Chris Boone, a partner at Venable, based in DC. My practice sits at the intersection of payments, crypto, and consumer protection. So I work with banks, acquirers, processors, ISOs, payback, merchants, payment networks, and fintech on regulatory strategy, contracts, and getting products to market without regulatory headache. On the blockchain side, I advise on stablecoins, other cryptos, and token platforms, including licensing, exemptions, custody arrangements, and disclosures and consumer protection issues. My goal today is to kind of translate the current crypto legal landscape into practical choices that you can use right away. So here's the agenda for today. We'll start with a quick look at the landscape, what's changed over the past year, how the new federal framework is shaping stablecoin programs. And then from there, we'll move to the architecture side of things, how these programs are actually built, how money and tokens flow through the system, and where the key risk points are. So we'll talk about real world compliance pieces, anti-money laundering, sanction screening, consumer protection. Those are among the make or break areas for many programs. We'll round out our discussion with some third-party risk management because every program relies on a multitude of service providers. So making sure that those are up to snuff is critical. And then finally, we'll close with a recap and a cheat sheet, if you will, for implementing these types of programs. As we go along, if anything sparks a question, please feel free to drop it in the chat, and I'll try to get to it if we have time at the end. So why now and why stablecoins? Well, we're at a real inflection point. Stablecoins are moving from proof of concept into full-scale production-grade programs. They can settle in seconds instead of days and offer the potential for programmable payments and other attractive features in a variety of contexts, including merchant settlement, payroll, vendor invoices, and cross-border transfers. So what's different today is that we finally have a federal framework that defines who can issue stablecoins, how reserves must be held, and what investor and consumer protections apply. So that clarity gives banks and payment companies and others a green light to build, but with oversight and risk management. So first, let's do some quick definitions and terminology so that we're on the same page. A payment stablecoin, that's the term used by the Genius Act, and it is a digital representation of value that's designed to maintain a stable price and to be used as a means of payment or settlement, and is backed by reserves and high-quality assets. A permitted stablecoin issuer is the company or bank that is issuing the permitted payment stablecoin under the Genius Act issuance framework. By contrast, a digital asset service provider, or DAS for short, they're entities that provide certain digital asset services such as exchanging, on and off ramping, facilitating transfers, acting as custodians, or providing other financial services related to digital asset issuance. Custodians are a type of digital asset service provider. They hold and safeguard the digital assets, including the private keys. Separately, there are also entities that will hold and safeguard the reserves for an issuer, and those types of entities must be subject to federal or state banking supervision. So how do fiat-backed stablecoins actually work? Mechanically, they're pretty straightforward. When a user pays $1 to the issuer mints the same number of tokens to the user's wallet, and then on redemption, the issuer burns the tokens and then returns the dollars. The payment is transferred into the issuer's reserve, which sit in cash or near cash instruments like treasury bills. And as long as the user trusts that they can redeem their stablecoin tokens at face value, they essentially function as digital dollars. The reserve model here is key. And the reserve requirements under the Genius Act, which we'll get to in a little bit in more detail, they stem from issues with what were called algorithmic stablecoins. These types of tokens were not fully backed by reserves, but instead used mint and burn arbitrage and supply adjustments, and like a companion token with complex algorithms to try to maintain the peg to $1. The problem was that didn't always work. And if confidence cracks, it can spiral out of control. And that happened with Terra USD in 2022, resulting in billions in value being kind of wiped out in a short week, and with significant broader market impact. And that experience has helped shape today's rule. So with that background, we'll turn to a kind of quick overview of the legal landscape. The primary legal anchor here is the Genius Act, which we'll cover first, but it's not the only regulatory consideration. So Genius creates the federal framework for US dollar-backed stablecoins, and it signals significant changes ahead in the digital asset space. Most of the Act provisions have not fully taken effect, and agency rules that have yet to be developed will be developed and implemented over the next few years. So there's still some moving ground that is needed to be sorted out. There are a number of important provisions, but among the main takeaways is the overall permission structure. It's kind of like a license, but it's not necessarily called a license. So whether you're a bank, a payment processor, fintech, or something in between, you must get approval first to issue stablecoins. So this ends the era of unregulated issuance. And significantly, issuance is not limited to banks. Non-banks are eligible to issue stablecoins. This was a hotly debated topic during development of the bill. Previous proposals, like the Waters-McHenry bill, tried to limit issuance to insured banks. Here, the compromise was to let the OCC supervise non-banks under this new regime. Another important element is this 120-day shot clock for application decisions. If the regulator fails to approve or deny an application within 120 days, the application is automatically deemed approved. This is a powerful tool. It forces regulators to act on applications and is designed to prevent the kind of regulatory limbo that many crypto firms have complained about for years. The reserve requirement is also critically important. One-to-one reserve, full 100% reserve backing. And strict redemption rules reflect the Act's emphasis on both payment functionality and the overall safety and soundness of the system. Reserves have to be in very safe assets, essentially treasuries, cash, or equivalent. Anything resembling risk-taking, like crypto, corporate debt, or equities is off limits for reserves. The Act also includes robust redemption requirements. Holders must be able to convert back to dollars quickly. Ultimately, this is designed to make the stable coins behave like digital cash. There's also a ban on yield. This means issuers cannot lend, invest, or otherwise use the reserves for their own gain, and stablecoins cannot offer holders interest on the stablecoins merely by holding the stablecoins. Finally, the Act has an interesting dual structure, a dual federal state structure based on issuer size. Federal regulators get automatic control over big issuers, those with more than 10 billion in issued tokens. But smaller issuers can operate under state law if the state has implemented rules and those rules have been certified as being consistent with federal standards. So once an issuer that's under the state rules crosses the 10 billion threshold, then the federal oversight is effectively exclusive again, and the state regulator is no longer the primary supervisor. So what about digital asset service providers? Well, the Act doesn't do too much with them, except for in 3 years after enactment, unlicensed stablecoins will be barred from being supported by US entities. So that includes platforms, custodians, and DAF. So this is a huge change that will force companies and existing issuers to either comply or risk losing access to US customers. 3 years is a long time, but if you're not paying attention and being careful, it will happen faster than you might think. So this could be particularly impactful for foreign issuers, as the Treasury must first certify that the foreign issuer is subject to a substantially similar regulatory regime. And that's largely outside of their hands. That would be, their nation or country creating a regulatory system and then having that certified as being, substantially equivalent to the US regime. With regards to bankruptcy, if an improved issuer fails, stablecoin holders have first claim on the segregated reserve assets. That makes sense. Those reserves are excluded from the bankruptcy estate. That might not have been something you would initially think, but that's how it is structured. They are wholly walled off and separate from the kind of normal bankruptcy estate. And in addition, if the reserves, for whatever reason, are not sufficient to make holders whole, then they have super priority claim on the estate for that shortfall. The bottom line is that this is designed so that holders get paid before everyone else, ahead of all other creditors. It's also worth noting about this override of the SEC's Staff Accounting Bulletin 121, as this is a pretty big deal for banks in particular. The bulletin required banks and other regulated financial institutions to treat any digital assets they held for customers as liabilities on their balance sheet, which made crypto custody very costly by inflating their capital and reserve requirements. Although the SEC reversed this guidance in January, the Genius Act now codifies by statute that regulators cannot require custodians to treat digital assets as liabilities. So what about platforms and exchanges? DApps, including crypto exchanges, may offer or sell payment stablecoins only if those coins are from a permitted issuer or permitted foreign issuer that meets the US equivalent standards, which I mentioned. And while I touched on the DApp definition earlier, I decided it would also be helpful to fully list out each of its elements. Again, this is, exchanges, anyone involved in the transfer of stable coins or other digital assets, those that provide custody or related financial services. But there are also some important exclusions. Protocol developers and validators are completely excluded from this definition. So with the general kind of legal structure out of the way, now we'll move to program types and how these programs are built from the ground up. So there are endless permutations we could discuss, but I'll highlight a few. But first, it's important to get a handle on the ecosystem as a whole. Players in this space include issuers, banks, trust companies that hold reserves, technology platforms that provide wallets and other controls, regulated service providers that can let you offer certain crypto features without having to build new products yourself, payment processors and acquirers that add card and payment acceptance, exchanges and market makers that provide liquidity, compliance vendors that handle KYC and sanction screening, analytics firms that kind of score blockchain risks, as well as auditors that can check reserves and other program controls. A single program may and probably will involve several of these actors at once. So the kind of basic structures would be you have a bank issuer that keeps minting and burning reserves inside its own bank perimeter. You could have a non-bank issuer that partners with a bank for reserve custody and fiat rails. Or you could be looking at a service provider that is wanting to work with an issuer or to integrate an issuer's token into its own services and enable custodial or non-custodial wallets, provide checkout services for merchants, or provide a bill payment platform, among other types of services. In every case, contracts must assign who handles different responsibilities: identity verification, sanction screening, wallet analytics, customer support, among other provisions and responsibilities. So with that in mind, program scoping is the first step, and it's a critical step. Program scoping starts by deciding exactly who you are in the ecosystem and what outcome you're looking to deliver. This can be issuing your own token. This could be enabling token purchases with cards and paying out in stablecoins as a settlement mechanism. This could be providing custody or providing stablecoin on and off ramps, among others. Once your goal in who you are in the system is identified, the next step is to identify pretty much every third party you'll need and determine what can be done in-house. This is easier said than done. But does your project require a bank to hold reserves or customer funds? Does your project require wallet providers, KYC vendors, blockchain analytics, key management and sign-in services, liquidity and settlement partners? Once that is identified, once a roadmap is built, a responsibility matrix can help map what needs to be done and where. And for each function, whether that's onboarding, funding, transfers, redemption, customer support, it's equally important to designate an accountable owner. And then finally, as development ramps up, it's important to set service level expectations, such as onboarding times, settlement windows, redemption cutoffs, other elements for the particular program that is being built. The flow of funds is critical in any program, regardless of whether it's stablecoin, crypto, or just traditional kind of fiat. What this will look like will depend on your program, and your company or your program might not even sit in the flow of funds. But even if that's the case, it's still critically important to understand the entire chain of custody and touch points. So you should draw an end-to-end picture that shows step-by-step where value sits, who controls it, from customer funding to mint to transfer to burn, in redemption, or if you are a service provider that is providing a checkout service, are you in the flow of funds? Is the fund going directly to you and then to the merchant? Are there other in-betweens? Each of those steps should be drawn with specificity. This includes labeling the accounts and wallets and how those accounts are named, the other custody touch points, and who holds the keys or approval rights when it comes to stablecoins or other cryptocurrencies. All of that information, which is complicated and it is a lot, it is vastly superior and vastly helpful to have a clear, mapped out map of the flow of funds. When or if you partner with a digital asset service provider or integrate stablecoins, you need to do a full spectrum diligence, including for regulatory status and compliance, ownership integrity, business model, and again, that complete flow of funds. In many cases, if you are part of a stablecoin project, but you are only one aspect of a larger project, you might not have direct insight into the flow of funds, but the flow of funds might still be critically important to the overall regulatory risk, particularly money transmission risk of that program and your role in it. So it'd be important to ask to see that flow of funds and to understand that flow of funds in pretty much any situation. And in addition, you should also review consumer terms and marketing claims to the extent those are applicable to your program. Evaluate financial condition, fraud prevention, dispute handling dependencies, and operational readiness. This isn't a check the box type of exercise. This is how you avoid outages, errors, and headlines of the bad type. So now we're going to move to program compliance. The door is now open to innovation, but it is a door with guardrails. Compliance is what earns that trust and keeps that door open for the next phase of growth. So as we turn to compliance, think of it again not as a checklist, but as a framework that keeps a program credible, durable, and safe to scale. So what do regulators expect? Supervisors have been clear that crypto cannot live in its own corner. If you're issuing or supporting stablecoins, those activities must fit inside your existing enterprise risk and compliance and audit framework. Just like lending or payments or deposits, this means that crypto activities should not be siloed or treated as exceptions. They need to be integrated into the risk framework. Regulators also expect issuers and DAFs to build or bring in real expertise to manage these blockchain-related risks. It's fine to use vendors, but you can't outsource accountability. Your team needs enough in-house knowledge to understand what vendors are doing and to challenge them when necessary. And examiners already have a checklist in mind. They're looking at governance and board oversight. They are looking at internal controls and audit trails. And they're looking at ongoing compliance with the evolving guidance from the OCC, FDIC, Federal Reserve, or FinCEN, and the SEC as applicable. Supervisors also focus heavily on safety and soundness. Particularly for issuers, they need to show that their crypto activities do not put their capital, liquidity, or operations at risk. That means holding strong liquidity buffers to back every stablecoin circulation, that's the reserves, and managing exposures carefully so balance sheets stay stable during stress. The guiding idea is pretty simple in just general terms. If redemptions spike tomorrow, the system still needs to run smoothly. And I mean, and again, that's easier said than done. That requires both practical and technological solutions, in addition to just on paper having a legally compliant program. And so compliance expectations are just as firm. Crypto transactions in particular bring heightened risks of money laundering, terrorist financing, and sanctions evasion. So the Bank Secrecy Act and the anti-money laundering rules in the sanctions law all still apply in full. Monitoring, customer due diligence, suspicious activity reporting must be designed for crypto's unique characteristics. These are fast moving and global. And then finally, if you are relying on vendors for custody or payments or execution, regulators expect full third-party risk management. This includes documented diligence, contractual safeguards, and continuous oversight throughout the relationship. We will talk through these, especially third-party risk management, in more detail in just a little bit. But first, I have a CLE code. It is Pilot 2025. That is one word in all lowercase, but the case, I don't believe it's case sensitive. It is Pilot 2025. So continuing with regulatory expectations, operational and cybersecurity risks are also front and center for supervisors. Blockchain-related activities, as you probably can intuit, bring some new operational risks. Regulators will expect issuers and DAS to show fluency in how blockchain transactions work and to prove that they can manage the cyber threats unique to this space. That means protecting private keys, monitoring for smart contract vulnerabilities, and having tested incident response plans ready to go. On the consumer side, transparency is essentially non-negotiable. Programs need to be clear and have plain language disclosures and terms applicable to that program and spell out all the material terms. What fees apply, if any? How do redemptions work in the case of an issuance program? And what rights users have or obligations do they have? The goal is that anyone reading your terms or looking to use your services understands all of those key points without needing a lawyer to tell them what it means. And finally, you shouldn't overlook record keeping. Regulators expect formal retention policies to preserve communication, on-chain transaction records, audit trails, because when or if something goes wrong, that documentation is your first line of defense. So we've talked a little bit about money transmission, but it's worth getting into a bit more detail here because money transmission compliance is still relevant. So a party that accepts and transmits or even exchanges value on behalf of another is generally treated as a money transmitter. That means registration with FinCEN as a money service business, state money transmission licenses, and compliance with all of those related obligations stemming from that designation. That means a non-bank that issues a stablecoin usually fits that definition because it's accepting fiat and transmitting tokens back to users. Now, banks are not money service businesses by definition, but they're still fully subject to the Bank Secrecy Act and compliance expectations. Custodians in many DAFs also fall within the federal and state money transmission rules, and depending on where they fit in the flow of funds, may trigger that money transmission, money service business definition. Under the Genius Act, stablecoin issuers are explicitly treated as financial institutions for purposes of the Bank Secrecy Act. The Act does direct FinCEN to set tailored anti-money laundering rules for issuers, but until then, issuers should assume the existing money service business and money transmitter obligations continue to apply. And these rules likely will not deviate too far from the existing rules. So they provide a pretty good roadmap for what to expect. So as a result, every issuer or service provider that is involved in the flow of funds needs a strong, risk-based anti-money laundering program. The basic elements haven't changed, but how you apply them in a blockchain environment requires some more thought and requires a bit more precision. An AML program starts with internal controls. These are your policies and procedures that govern customer identification, sanctions screening, monitoring, investigations, record keeping, and reporting. These form a backbone for daily compliance. After those internal controls comes independent testing. This could mean an internal audit or external review, but it must be objective and must be reoccurring. You also need to designate an AML compliance officer. This is someone empowered to make decisions and allocate resources. This is ultimately the owner for anti-money laundering compliance. This is the contact and touch point between your company and the relevant regulator, such as FinCEN. And then finally, like training is also critical. So staff, not just the AML compliance officer, understands what their obligations are. For example, when it comes to monitoring suspicious activity or issuing suspicious activity reports and other types of transactions. It's critical that staff understands both traditional and crypto and stablecoin specific risks. And then also there's your customer due diligence, your KYC, and ongoing monitoring. This too needs to be tailored to the geographies and the customer behaviors that you're going to face. Stablecoins and cryptocurrencies occupy an interesting vertical in the payment space, in the movement of funds space, because unlike cash, and contrary to what many think, they're not completely anonymous because they're based on a blockchain. There is some traceability, and so these different unique qualities need to be taken into consideration in how you map and shape your overall money and anti-money laundering program. For banks, there is this rule known as the Customer Identification Program Rule, the CIP rule, if you will. This is the foundation of knowing who your customer really is. The CIP rule requires banks to collect enough information to form a reasonable belief about each customer's true identity before an account is opened or a customer relationship is formed. At a minimum, this means 4 core data points: the customer's name, date of birth, address, and an identification number such as the social security number or taxpayer ID. This SIP must also include written procedures for verifying that information, right? It's not enough to simply have that information, you have to verify it. So that can involve documents like the driver's license or passport, or non-documentary methods such as database checks or referencing other verifications. The goal is simply to be able to confirm that each customer is who they are claiming to be before any funds or assets enter the system. So going on to sanctions compliance, this is one of the most serious areas that regulators focus on. The Office of Foreign Asset Control, or OFAC, is responsible for administering and enforcing US economic sanctions programs. Compliance obligations apply to all US persons. This includes any company physically operating within the United States and all US incorporated entities, including the foreign branches, as well as all US citizens or those that are permanent residents in the US. At its core, a sanctions program does 3 things. It names who you cannot do business with. It defines the transactions you must block or refuse, and it prescribes the actions you must take when you encounter blocked property. In practice, this means continuous screening of customers, counterparties, and transaction parties against these designated lists, like OFAC SDN list, the specially designated nationals and blocked persons list. I know it's a bit of a mouthful. And remember, sanctions are not merely advisory. Prohibited transactions must be blocked and in many cases reported, and violations can lead to pretty severe civil and criminal penalties, often on a strict liability basis, meaning you can be liable even if you didn't know it was a prohibited transaction. So consumer protection, just changing pace just a little bit, is also one of the most visible ways regulators can judge a program's credibility. Every disclosure should clearly explain how the product works. So for an issuer, that would include, what the reserves are comprised of, how redemption works, what are the redemption timelines, any limitations, any fees, any rights or obligations. And the goal, again, is plain English transparency. And to that end, that means, just for one example, avoiding language that suggests deposit insurance or a guaranteed return. Under the Act, it's explicitly not okay to say that the stablecoin reserves are, or your stablecoin holdings rather, are insured by the FDIC or anyone else for that matter, because that's just not the case. More broadly, companies in this space need to have written policies and clear responsibilities for handling complaints, refunds, or error resolution in a way to kind of measure and report performance in each of those areas. And with regard to marketing, consistency is key. Claims should be pre-cleared with legal and compliance. They should be supported by evidence, They should be aligned across different channels, the website or app stores, social channels, and any endorsements must meet the FTC's endorsement standards. And again, the insured language should never appear unless it's strictly accurate, which, for FDIC insurance, certainly it would not be. Redemption in case of an issuer is the single most important promise a stablecoin issuer makes. So regulators expect it to be clear, public, and verifiable. Under the Genius Act, an issuer must post its redemption policy. And this redemption policy must be easy to find and written in plain language. It should state that redemptions occur at par value, that's the face value of the token, describe how users can submit redemption requests, note any cutoff times, and explain how disputes are handled. Operationally, teams should regularly test redemption timelines end to end and record actual performance against what is being promised in the redemption policy. If there are any exceptions, if there are any delays, errors, or system outages, these should be tracked and resolved and reported to senior governance with a root cause analysis. In short, redemption can't just work most of the time. It has to work every time. So now we're moving on to third-party risk management. Third-party risk management it's really the discipline for how you manage everyone who helps run your program. It covers the entire life cycle of a program, including planning, due diligence, contracting, oversight, and eventually termination or transition. The goal is to identify and control risks before they turn into problems. Vendor management is the operational side of that framework. It applies those same life cycle controls to specific partners, whether that's a technology provider, a wallet, or a key management firm, custodian, analytics vendors, and so on. The banking supervisors in the FFIEC have detailed expectations for how financial institutions should oversee outsourced technology services. Those expectations apply just as strongly to stablecoin programs. Even non-bank issuers are expected to maintain comparable oversight over every service provider supporting their operations. And so you can kind of see a theme here. Stablecoin programs rely on a long chain of counterparties. This includes issuers, reserve custodians, wallet operators, blockchain infrastructure providers, analytics vendors, and more. The challenge is that failure at any one of those points can halt minting, burning, redemption, or even basic customer support. That's why supervisors have emphasized treating third-party risk as systemic. It's not incidental. So the interagency guidance makes clear that each relationship must be assessed by its criticality, and some vendors will be core to your operations, while others may be easily replaced. So the oversight you should apply should match the level of risk. And that requires assessing that risk and assessing the criticality. Even if it might be easily replaced, What level of access do they have to your systems or to your data? If something went wrong, how catastrophic or minimal would that be to the services? Understanding those elements will help pair your level of oversight to that particular vendor. Stablecoins also introduce distinct cybersecurity risks. Key custody, signing services, smart contract implementation in particular, and node operation all require really tight controls. The latest cybersecurity framework 2.0 folds third-party supply chain risks into enterprise-wide governance expectations. These are great resources for getting up to speed, particularly in terms of cybersecurity risks and how to manage those risks. So with that kind of general background, what are the main elements to a third-party risk management program? This starts with governance and risk appetite. So the board or senior leadership should approve a written framework that defines who makes which decision, how risk tolerance is set, and how issues get escalated, especially for partners involved in minting or custody, wallet operations, or incident response. Before signing a contract, you should conduct deep due diligence on the partner, assess the partner's financial condition, their regulatory track record, leadership competence, information security, and even their subcontractor chains. Contracts should also clearly assign responsibilities, including audit and data rights, define service level expectations, and contemplate exit and transition support. All of these issues and more should be very purposefully considered in contract negotiation. After launch, monitoring should again match that partner's criticality and customer impact. It will be important to remember that it's not just sign and forget. Monitoring must be ongoing. And then finally, you need to have an exit playbook ready, right? This needs to cover data return, key transfer, consumer communications, and continuity of the services as applicable. If things end abruptly, it will be very advantageous if you have a plan ready to go for when that happens and what that means for your services. There is also a kind of a need, just taking a step back, to balance innovation with where the industry stands today. Crypto activities such as stablecoin are still viewed as novel. Even as barriers are falling, regulators remain cautious and continue to examine these programs through traditional lenses of safety and soundness. That scrutiny isn't going away. And regulatory guidance is also evolving. There are joint agency efforts underway to provide clear guardrails, but those are not finalized. And issuers and digital asset service providers are expected to hold themselves to high internal standards of governance and transparency even before those rules are finalized. It would undermine the faith in the entire system if there were kind of systemic issues prior to rules being finalized. At the same time, adoption is accelerating. Consumers and institutions are integrating cryptocurrencies and stablecoins into real-world finance. The opportunity is huge, but so is the responsibility to balance these new approaches with strong compliance and safety controls that keep trust intact as the market grows and matures. So to summarize, here's a kind of a quick and condensed cheat sheet. So first, translate all regulatory requirements we've discussed into tangible program pieces. That means written policies, clear procedures, and evidence of compliance. You shouldn't wait for an exam or a regulator inquiry to start building these. Proactive documentation shows maturity and shows good faith at working towards compliance. Good programs are subject to regular testing with records of what was tested and when, and with compliance teams involved from the very beginning of product design through launch and maintenance and ongoing thereafter. Second, like you should focus on how you evidence compliance. Being compliant is one thing, but if you can't evidence it, then that can be a problem. So for example, this can be evidenced by keeping records of training attendance, testing routines and results, and so on, keeping those records. So when there is an issue or there are questions, you can point to those records to build a case for your program. And going along with testing, it is also equally important to schedule independent audits and testing and making those results available to regulators and key partners as applicable and when necessary. Documentation isn't paperwork. It's proof that your program works. And so as we wrap up, the kind of message I want to convey is that stablecoin innovation and regulatory discipline are not opposites. They're two sides of the same token. The programs that succeed will be ones that design compliance and governance into their DNA from day one. The Genius Act now gives us a clear framework, more clear than it's ever been, but it also raises the bar. Issuers and digital asset service providers need to demonstrate not just that they can operate safely, but they can do so with strong risk management, transparent disclosures, and trustworthy partners. So start small, map your flows, test your controls, document everything. Each of those steps builds credibility with regulators, with counterparties, and with consumers. If industry can keep a mindset towards compliance and credibility, stablecoins move through the experiment stage to essential infrastructure, and that would be pretty great in my opinion. So that is my presentation. If there are questions in the chat, we have a little bit of time, then I might be able to address a few. Let's see. So there's a question about how we are expected to comply with a travel rule if a customer sends a coin to another wallet, i.e. the bank is not doing the sending. That is an excellent question. The travel rule and how it will apply in this context is a bit of an enigma. There are different interpretations you can take based on the statutory language, but until there is more clear guidance, there's no definitive answer to that question. Not that I'm aware of at this juncture yet, but that is a great question, and I will write it down and return to it because we are watching those types of issues closely. So who is responsible for enforcement of the 3-year unlicensed stablecoin US platforms? So this will be that is a good question because the primary stablecoin regulator, whether that's OCC, FDIC, etc., those kind of depend on the type of entity that is the issuer. But for a DAS that isn't being regulated as an issuer, who has enforcement authority in that case? Now that is an excellent question. As to who would bring an enforcement action in that case, I would need to dive into the language to be able to answer that. But what I would like to convey is, particularly for a platform, the Genius Act only really regulates platforms in one way, and that's after 3 years, they cannot trade in or offer stable coins that are not permitted stable coins or permitted by a foreign issuer. Other than that kind of restriction, they are not really regulated. Now, custodians have some extra obligations with regards to commingling and separate accounting, but that's kind of it. The vast majority of Genius is directed pretty squarely on the issuers. One question is, do you foresee a future specific stablecoin audit requirement similar to what PCI DSS lays out for payment card compliance? That's a great question. I think I can imagine something approximately like PCI DSS or stablecoins. It would probably take a while, and it'd be interesting to figure out what elements would be included in that. I imagine if the public wallet address will be akin to a credit card PAN number. But unlike credit cards, if you have their information, their credit card information, you can make fraudulent charges as long as you don't trip up too many like fraud flags by having that information. But just having that information in the stablecoin context doesn't mean you'd be able to make transactions. You would need the private key, and the private key, is that important? I mean, that's basically like holding the cash. If someone gets a hold of it, they have your cash. Yeah, that's a good question. I would be very interested to see what kind of privacy, data security elements get thought up of for protecting stablecoins or other crypto types of programs in the future. And with that, we are at 2:59. Thank you. I hope you guys had a enjoyable view of the presentation and learned something new. And I look forward to seeing you again in part 3 of this 3-part series next month. And as a final reminder, the CLE code is Pilot 2025. One word, all lowercase. But it should work anyways, even if you do an uppercase. Pilot 2025. All right. Thanks, everybody.